All right, well, what I'm going to do today is just kind of give a quick update on what's going on in the crop market. I'm not going to necessarily focus on the CFAP payments, but if you do have any payments or any questions on those payments, please just let me know. You know, there is still a fair amount of issues out there that have not necessarily been fully resolved, but we are starting to see payments go out to producers. So just to kind of get some current developments right off the bat, I'm sure most of you are aware of this or at least heard of this, that the EPA's order restricting the sale, distribution, and use of Dicamba products. Essentially what it indicates is that you can no longer purchase it. If you did have it on hand, as of June 3rd, you can continue to use those products. There is one exception to it, and the name of it escapes me, where there is still a Dicamba product that's not one of those three main ones that is out there, but Dr. Steckel was telling me that the supplies of that are pretty limited. Now we'll have to see how this plays out for the rest of the year. Hopefully most producers have current reserves that will make it through this current crop year, but hopefully there's further resolution to this as we move forward. The other one that I kind of alluded to earlier, we have seen the CFAP payments, the Coronavirus Food Assistance Program payments, start actually making it out to producers this past week as of June 8th. So each Monday they're going to update how many payments they've put out, and this is specific to Tennessee. So we've seen just over $5.4 million go out to 734 applications on the non-specialty crop side of things, with the total payments to Tennessee producers just over 13.3 million, with 4,200 applications processed. So there's still a substantial amount of payments to go out and applications to process, but they are starting to get some money out to producers through these programs. There still isn't any additional clarity on when and how we will see that additional 20%. If you remember, we're only getting 80% as an initial payment, and then there'll be 20% that will be deemed at a later date. So when we look at what's driving crop prices right now, obviously nothing happens in a bubble. We like to attribute, you know, a substantial amount of the current price declines to COVID-19, but there are, you know, numerous things that are going on, and they're all kind of interconnected. So everything from, you know, COVID-19 and the influence on the U.S. and global economies. We still have obviously that strong weather influence both here and across other production regions. And then again, lingering in the background is still that trade and the trade war with China. Are we going to be able to fulfill those phase one trade agreements? And then kind of providing kind of an underlying blanket is that global and U.S. stocks and production picture, which there is a substantial amount of product out there. And so we'll kind of talk about what the ramifications that's going to end up providing as we look at our projected prices. So this graph, I've shown it a few times. I updated it as of yesterday. So you can see what the percent declines were in Tennessee row crop spot price. So this is the old crop price from January 1 to June 8th. You can see our initial prices. You know, it seems like a long time ago, but if you remember back in early January, we did have corn cash prices over $4, cotton, you know, just under 68 cents, and soybeans just over $9.50, wheat just under $6. Since then, we've seen them kind of bottom out. Obviously, cotton and corn were the ones that were really hit hardest, where cotton was down at one time 32%, corn down 24%. Soybeans got down to about 12.8% from this initial point, and then wheat was at 14.7%. Since then, we've seen them bounce back up. They're still, you know, anywhere between 6% to 14% below where we started the year. So when we look at COVID-19, obviously it is a contributor to the price declines, but you can't contribute all of that price decline to COVID-19. It's a very important factor, and it's really difficult to try to separate out what those different factors are and how they're moving markets on an individual basis. But obviously there has been some reduced demand side on the row crop side of things, both from a trade standpoint and then on the ethanol side for corn. There's been some logistical issues, and then as Andrew, I'm sure will speak to, some processing bottlenecks that have created some issues in the meat sector. Underlying all this is the economic uncertainty. We really don't have a great idea where the economy is going to go, but there are some initial potential signs that it could be improving. The CFAP payments, again, they will help on the row crop side mitigate some of the old crop price reductions, but it doesn't affect the new crop. One thing that it does affect on the new crop side of things right now, in terms of the price declines, is that we've probably compressed the marketing interval. I'll talk a little bit about that later. So I mentioned economic recovery. We've seen things bounce back. I've got a couple of just real basic kind of macroeconomic indicators up here. When we look at what's going on in the stock market, this is the S&P 500 index. What we ended up seeing was a substantial decline. It bottomed out March 23rd at 2,200. And since then, we've not quite got back to where we were back in January, February, but we are trending in the right direction. This was one that really surprised a lot of analysts, I guess. It was last week when this came out, when they ended up saying that the unemployment rate was 13.3%. A lot of analysts were predicting it to be much, much higher. Again, it's still substantially higher than where we were, but again, it's not as bad as it maybe could have been. So again, this does bode well for potentially having a bit of an economic recovery. One key date that I'm really looking forward to seeing how numbers respond to is when the federal unemployment boost ends in July. What that does to employment and people getting back into the workforce is going to be really interesting to watch. In terms of kind of weather, what we've seen during the growing season right now, planting progress, we've pretty much got most of the corn crop planted in the US. We had some challenges in West Tennessee and other parts in terms of wet condition that affected both corn and cotton planting. But as of right now, we've had reasonably good planting progress relative to last year in particular, and our crops in general, both in the US and Tennessee, are looking pretty good at this point. We look at globally, there are some interesting problem spots potentially. Europe's got some issues with weather, particularly some dry conditions that are affecting wheat. I'm not going to spend a lot of time talking about wheat, but I will give kind of a quick overview of what's going on. This is a real interesting resource. It gives you kind of an update of the crop growing conditions in key production regions. Obviously, one of the challenges that you do have to be able to do is to pick locations that have different commodities that are being produced. So for example, when you're looking at this, you have to know which areas of the globe are looking at soybeans versus maybe more wheat, corn influence. But it is an interesting resource where you can kind of get a global picture of what's going on in some of the key crop production regions. Jump into corn real quick. I'm not going to spend a ton of time on supply and demand, but I do want to provide a quick update because they did release the 2020 numbers back in May. And unfortunately, they are looking a little bit bearish if they are realizable. A lot of this is driven by that 97 million acres projected to be planted for corn. I think that's going to come down a little bit just because of some of the planting issues that we've ended up seeing. And then we ended up seeing that corn soybean price ratio kind of tip in the last 3 months so that it wasn't as favorable for corn for a lot of areas. So again, I'll be interested to see how close they get to this 97 million acres planted. Obviously, we don't know what our 2020 yields are going to end up being. They've got a trend line yield about 172 bushels per acre on average for the US. And then a big one to me is how ethanol recovers. It basically, what we ended up seeing is weekly ethanol production was decreased by half during this COVID-19 pandemic. It's come back up, so we're at about 3/4 of production. But it does use about 5 billion bushels of corn. So it's a substantial amount of our 12.65 billion bushels of domestic use. It'll be interesting to see how that ends up bouncing back. And you know, if all these plants get back up to where they were in terms of capacity and operation before COVID-19 ended up hitting. The one that is kind of really problematic when we look at it from long-term price, and again, this is projected, so it's not realizable at this point, but if we hit that 3.3 billion bushels of corn on reserve in the US, that's going to put a pretty hard cap on top of what our price expectations are going to be for the 2020 crop year. Now, some of that may be able to be mitigated by exports, and bring that number down a little bit. But unfortunately, that's a number that's going to be real challenging to get prices back above that $4 range if that is the true number when we look at what happens after this crop is harvested. On a global supply, same type of picture where we're looking at substantial reserves. There is some big questions on the demand side. And again, typically we take demand as reasonably stable. If you want to kind of take a real basic metric to end up calculating demand, we usually make it a function of population in some capacity. That's not 100% accurate, but it is something that provides you a reasonable estimation. With the coronavirus issues, demand has a lot more uncertainty, I guess is the best way to put it. A lot of it's going to depend on how the global economy snap back. We're still going to have to feed animals. We're still going to have to produce ethanol. But again, how that occurs and what that demand drag is as we move through the rest of 2020 and into 2021 is going to be really critical to see where we end up with in terms of these stock numbers. When you're looking at these stocks, that obviously has an impact on what our price expectations are going to be. One thing that has been reasonably good, and again, this is old crop basis, so it's the nearby contract that we're looking at, is that in Tennessee, our monthly corn basis is held up reasonably well. And a lot of that is because we had the reduced crop from 2019 due to those real wet conditions that we ended up having that affected a lot of planting issues. And so again, we've ended up having some reasonably good basis relative to where we have been. Again, these are for elevators and barge points. So if you've got a strong poultry influence or another major buyer of corn that's not recorded in that, you can see some substantially higher basis prices at those types of locations. Where we really ended up seeing the declines was on the futures side. And that blue line is the one that we're looking at. We're right around that $4 range to start the year. And then we've seen it come down pretty dramatically right around the beginning of March, where we were down well under $3.50. And one of the big issues that we have with that is, obviously, when we're talking new crop, we haven't harvested it, so we haven't necessarily sold much of that production. And particularly when we got into this window, as soon as prices started getting down into below that $3.50 range, there's pretty much no producer hedging or pricing that's going on at that point. So I mentioned it compresses that marketing window. And so again, what we have is we probably have more projected production that is unpriced at this point of time than other years. So again, what that means is that we'll probably have to have some additional sales between now and harvest, and then also at harvest as well. So again, that's something that the producers really need to think through is, one, how much of that crop do they have room to store? Because if you don't have room to store all of the crop, which most producers aren't going to have, then you have to end up selling it between now and when you are combining. So again, at that point in time, you have to kind of make a decision, well, what prices do I want to end up looking for? Do I want to look, if I see a little spike that gets into that 375 range, do I want to price, or do I want to roll the dice and see if I'm in this end of August into September, October, if we do end up getting prices that are a little bit higher? Great deal of uncertainty with that. Typically our harvest prices are depressed, but again, this is an exceptional time period due to the impact of COVID-19. So again, I don't know where you set some of these price points. I think if you do get somewhere close to that 375 and above, you might want to look at pricing some corn if you don't have the capacity to store. Looking at soybeans, again, you see that tremendous bump back from where we were last year. Again, that's attributed largely to those wet conditions where we've seen tremendous, I think it was 19 million acres prevented planted. So if you think about it from a supply and demand standpoint, imagine if we didn't have that disruption, where we would potentially be right now in terms of supplies. The good news on the soybean side of things is that we are trending down in terms of stocks. The bad news is that we're still pretty reliant on China with the export sales, and we don't really know what direction that's necessarily going to go. I'm cautiously optimistic that we can see some continued purchases. and I'll show you a graph on why that might be. And then also embedded in that is where are we at in terms of that acreage. If corn goes down, it's not always a 1-for-1, but typically if corn planted acreage goes down, soybeans are going to go up. When we look at monthly exports to China, and again, this is a little bit busy, but I wanted to put this up because there's a lot going on, obviously, with trade with China over the last 4 years. I use 2017 kind of as the benchmark. This is kind of where we were before the trade war, before COVID-19. And that's these black bars. And you can see we had a pretty typical pattern where we'd get substantial exports kind of as we started harvest and into the new year, and then they dry up kind of through the summer as maybe imports that China was looking for came from South America. When you look at 2018, that was the start of the trade war, and all of a sudden everything just kind of went away. We built back up in 2019, but we've seen an interesting pattern emerge where we ended up having some increased export activity in the summer months. I'm cautiously optimistic that unless we get some geopolitical issues, that we might end up seeing some continued sales during this time period where it'll bump up those export values, because we do still have some reserves on hand that could definitely end up heading towards China. We'll have to wait and see how that works out though. When we look at globally, again, we're still in a place where we have, you know, abundant global supplies. There still are some issues with African swine fever in China that could end up impacting demand. And as always, you know, how South American production is going to influence the soybean market tremendously. Similar to corn, we did have very strong basis bids relative to where we've been in the last 5 years as we move through the start of 2020. Again, where we lost a lot of our cash price was in the soybean futures, where we've seen, you know, we were already well below $10 a lot of the time, and a lot of that is related to the trade war, but we got down, you know, well below $9 on the November contract. Again, what that does is you're going to see that compression of that pricing interval. Look quickly at wheat. I'm not going to dwell a lot of time on wheat. I just want to point out a couple of things. One, what we've ended up seeing, if this graph went back, so we've seen a real reduction in U.S. wheat production. It's kind of flatlined. And so again, what we're essentially looking at is we're seeing about half, not quite half, go to exports and then half go to domestic consumption. But again, we have abundant wheat reserves, but it is starting to trend down a little bit, and a lot of that is a function of reduced production. Globally, unfortunately, and again, you have to be real careful with wheat because there's so many different types of wheat that we need to end up accounting for, but we are definitely not short of global supplies right now. When we look at where we are in terms of ending stocks, and you can see how consistent that demand has been in the past. One of the interesting things that we did see in wheat, just to kind of go to the July futures contract, is we did see this little bump in March and April when we ended up having the coronavirus. There's a bunch of issues for that. Some of it was Europe getting a little bit dry in some places. Another part of it was there was some countries that maybe, I don't want to call it panic buying because it's maybe not the correct terminology, but they did maybe purchase a little bit more on the export market than they would, or some of the countries that maybe didn't necessarily have the reserves that they would like to see didn't allow for exports to occur, and that did give us a bit of a price bump. Again, it's not all of it, but it is one of the factors that ended up influencing it. I know a lot of you don't have a lot of cotton, but I am going to just quickly touch on this. Again, lots of stocks. We are, you know, almost exclusively reliant on exports. When we look at these stock numbers, it is very problematic for us to get back up into, you know, anywhere close to that 70-cent range. If these are the stock numbers we're dealing with, it's going to be closer to 60 than 70 in terms of a price. Similar to soybeans, we do have a substantial amount of cotton that goes to China. We have ended up seeing kind of a reallocation of that supply chain where there is stuff going more through Vietnam than China. But again, it is something where under phase one, we could potentially see some additional Chinese purchases. But again, I'm not going to speculate on where the relationship between China and US stands politically, because I just don't have any inside information that would end up warranting any more than just saying that it's an important component of our demand. One thing that I do want to quickly, and this ties back to the importance of the global economy on our commodity prices. China was hit really hard, or cotton was hit really hard with prices. And a lot of that is because when you think about it, cotton, all commodities that we're talking about are going to be tied to global economic activity in some capacity. But the one that was really worrisome and why we've seen such a dramatic decline in cotton prices was the fact that it is so tied to consumer spending, right? If you don't have consumer spending on apparel, it backs up all the way through the supply chain to the individual cotton producer. So again, when everybody was worried about all these, all the consumer outlets not having any sales, that really affected cotton much more than some of the other commodities. You can see that steep price decline kind of back in March all the way through April, and then we've rebounded back up to that 60-cent threshold. But I think it's going to be pretty challenging. It's going to be a kind of more of a long-term struggle to get back up to that 70 cents, barring something dramatic in Texas or another key cotton producing area. Just kind of to bring it home, and before I turn it over to Andrew, in terms of what we're looking at for price outlook for the next few months here. Corn on the futures contract side of things, somewhere between 330 and 370. I think we'll maintain that higher than typical or higher than 5-year average basis as we go through this summer. Soybeans 840 to 930. Again, I think there's some more mobility there, and a lot of that depends on if we see a bunch of Chinese buying. There's some rumors out there that may occur. There's some rumors out there that they may cancel ag purchases if the Trump administration ends up digging their heels in on Hong Kong. So again, that's why there's such a wide band of potential prices there. Is just that there's geopolitical forces there that are very difficult to predict. Again, I think we'll see some bases kind of get back closer to normal levels as we move towards that harvest time period, and a lot of that is going to be a function of if we get back to normal plantings. Cotton 58 to 67 cents on the future side, and wheat 495 to 540 when we're looking at the futures.